The stock market's crashing, tariffs are shaking the world, and most investors are running for cover. But one man sees opportunity where others see chaos.
Carl Icahn, a prominent investor and 10% owner, has made significant acquisitions of common units in CVR Partners, a company currently valued at approximately $777 million.
Carl Icahn brings 2 directors to Caesars' board. What could be next as the activist aims to build value?
Today, we'll unpack the wild market swings from tariff fears to a stunning V-shaped recovery. We'll explore Icahn's bold bets on Caesars, aiming to fix its massive debt and grow online betting, and CVR, pushing into green fuels. Last week, global markets were thrown into chaos. The spark, President Trump's surprise announcement, a 145% tariff on Chinese imports. Just like that, fears of a full-blown trade war exploded. China hit back fast, slapping 84% tariffs on American goods. The response on Wall Street, pure panic. The S&P 500 plunged 3.5%. The Nasdaq dropped 4.3%. The Dow sank over 800 points. The fear, rising prices, crumbling supply chains, and the dreaded R word, recession. But then, just as quickly as the storm began, a twist. Later that same day, Trump pulled a classic move.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid. Somebody had to do what we did, and I did a 90-day pause for the people that didn't retaliate. And that's what I did with China, because they did retaliate. A deal's going to be made with China. A deal's going to be made with every one of them. And there'll be fair deals. I just want fair. They will be fair deals for everybody. But they weren't fair to the United States. They were sucking us dry, and you can't do that. Yeah, I saw last night where people were getting a little queasy. I think everything had, well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
It was his signature strategy, the art of the deal, and the markets loved it. The S&P 500 roared back, up 9.5%. The Dow exploded 3,000 points. Traders rushed back in, buying up everything they just dumped. It was the biggest one-day rebound since the 2008 crash, a dramatic V-shaped bounce that showed just how fast markets can turn when politics get involved. But don't let the green numbers fool you. Volatility hasn't gone anywhere. Big tech rallied after exemptions on electronics. Automakers breathed a sigh of relief too. Inflation cooled a bit, down to 2.4% in March, giving the Fed some room to breathe. But behind the scenes, fear still simmers. These tariffs are like landmines, and nobody knows when the next one will go off. And while most investors are still licking their wounds, one man is already on the offensive. Caesars Entertainment is no small player. It's the biggest casino entertainment company in America. You've seen the names Caesars, Harrah's, Horseshoe. They run across 18 states, lighting up the Strip and the Heartland alike. But Caesars isn't just blackjack tables and hotel towers anymore. It's gone digital, betting big on online gaming and sports betting. And at the center of it all, the Caesars Rewards program, a loyalty engine that connects the physical and digital worlds into one massive money machine. Sounds like a winning hand, right? Well, not quite. There's a problem, a $12.3 billion problem. Much debt Caesars is carrying, like a casino running on a giant credit card. Every quarter, those interest payments eat into profits like a hungry pit boss. Recently, they kicked the can down the road, refinancing and pushing major repayments to 2027. That bought them time, but the clock is still ticking. Carl Icahn sees Caesars not as a risk, but a bargain, a mispriced asset just waiting to be unlocked. His strategy? Cut the fat, shrink the debt, and go all in on digital. Icahn doesn't just talk, he acts. He's already installed his guys, Jesse Lynn and Ted Papapostolou, onto the board. That's a loud signal. He's not watching from the sidelines. but not everyone's betting with him. Critics say Icahn's playbook is too aggressive, that he might push Caesars to sell assets or spin off its digital arm too fast before the debt is under control. That kind of short-term thinking, they warn, could backfire. Carl Icahn helped pull off the 2020 Eldorado merger, a move that transformed Caesars into the empire it is today. He's done this before, and some believe he might just do it again. So the question now is Icahn building Caesars up or setting the table for a breakup? Down in Sugar Land, Texas, sits a quiet giant, CVR Energy. It's not flashy. It doesn't make tech or stream shows, but what it does make powers the backbone of America. Gasoline, diesel, jet fuel, and even fertilizer for our farms. CVR runs 2 big refineries in Kansas and Oklahoma. It even has a foot in the future, producing renewable diesel from soybean and corn oil, a growing play in the green energy space. But 2024, it was brutal. Sales dropped nearly 20%, and operational headaches piled up, shutdowns, a power failure in Q3, and winter damage that's forcing a major maintenance project at the Coffeyville refinery in early 2025. Icahn owns 80% of CVR. And even after a dismal year, he's doubling down. In April 2025, he bought another $6.2 million worth of CVR shares. Why? Because he smells opportunity. Trading at just $16.35 a share, near its 52-week low, he sees a beaten-down asset that still has solid bones. His plan? Tighten operations, cut costs, push deeper into renewable fuels. If he can turn around refinery efficiency and ramp up green diesel, CVR could ride the next wave of energy demand. There's talk, serious talk, that he may go after Citgo Petroleum, a deal that could be worth $8 billion. It would be bold. It would be messy. But if it works, CVR could leap from regional player to national powerhouse. Of course, not everyone's convinced. With $1.9 billion in debt, a shaky 2024 behind them, and more repairs ahead, some worry Icahn's aggressive moves could backfire. His playbook is high risk, high reward. And if refinery issues continue, or if green diesel doesn't scale fast enough, CVR could stay stuck. But this is the Icahn method. Find the weak spots, shake the tree, build value, or force someone else to pay for it. The question now is simple. Will CVR become Icahn's next great turnaround? For decades, Icahn's made a career out of buying when others flee. He doesn't chase hype, he hunts value. And when markets tumble, when the headlines are all red and the herd is stampeding, that's when Icahn digs in. In 2025, while most investors clutched their portfolios and prayed, Icahn was making moves, big ones. He scooped up $27 million worth of CVR stock near its lows. He installed his allies onto Caesars' board, signaling, "I'm not just betting, I'm driving." His strategy is ruthless in its simplicity. At Caesars, cut the $12.3 billion debt and double down on online gaming. At CVR, fix the refinery mess, expand renewable fuels, and maybe take a run at Citgo. He doesn't wait for the market to calm down. He thrives in the chaos. He bets when others break. To Icahn, bear markets aren't warnings, they're invitations. And maybe he's right, because if history has shown us anything, it's that the big money isn't made during the easy times. It's made in the fog, in the noise, in the fire. And right now, while most are watching from the sidelines, Carl Icahn is playing the long game with the whole table in view.